Welcome Team 65 to the JD Finals of the Law Student Tax Challenge. Congrats on making it this far. Without further ado, I'm going to turn it over to Dick Lipton to kick us off. Dick, over to you.
Thanks, Brandon. And your clock is not starting to run yet. We'll tell you when your 25 minutes starts to run, just so you can relax for a moment or two more.
Nice.
I'm Dick Lipton. I'm senior counsel at Baker McKenzie, based out of both Dallas and Chicago. I'm also serving, obviously, as the judge here. The reason I'm one of the judges, and I'll introduce my colleagues who are actually much more capable than I am, is back when I was chair of the tax section 20 years ago, I founded the Law Student Challenge. So it's one of the legacies that I left from my term, and I'm pretty happy to do it. What you will, as you know, this is the finals. What happens in the finals is this is allegedly a meeting where you're presenting to the client. For purposes of this, we have our clients here. We have Judge Diana Layden, from special trial judge with the U.S. Tax Court. But for today, her name is Lucy. And we have Rochelle Hodis with the Crow accounting firm. And today, her name is Jimmy. And you can decide whether you should change all the he's, and they're the married couple, and they're well, sort of married, since I think they're heading towards divorce. And I'm the partner in the firm to whom you're making the presentation. And I think without further ado, we'll let our timer get going. And as they say on Chopped, your time starts now.
Hi, thank you everybody for being here today. Thanks for meeting with us. My name is Michael. My partner here is Louie. We're with JD Team 65, and we only have 25 minutes here today. So we want to make sure that we answer all your questions, but also that we get to all the issues. Louie?
So thanks, Mike. Lucy and Jimmy, we researched the 4 main issues that we found with you, and we want to address them one by one. So the first one is going to be the audit, where we think you have very strong arguments in favor of the position that when your dad forgave the debt, it was a gift and therefore not included in your income. And we'll discuss how we can move forward in order to resolve the issue without necessarily having to go to court. The second part, we will want to explain to you how we can deduct your band's expenses going forward. The third part, we will talk to you about the New York City renovations and how the CARES Act will allow you to take a pretty big deduction this year. And finally, we want to cover the potential tax consequences of your divorce. So the first part is about the audit. Our understanding is that either you got it today or you're expecting to get very soon a notice of deficiency with regard to when your dad forgave $175,000 worth of debt that you used to pay for the down payment on the house in Provo. Our point is that this was a gift, and the general rule for debt forgiveness is that Section 61 of the code says debt forgiveness is income. However, the code also says that a gift is not income. So that includes debt forgiveness. So that means that if your dad's debt forgiveness is qualified as a gift, then it is not excluded from your gross income. The way we know.
Can I just ask,
sure.
Did Dad file a gift tax return when he forgave the debt?
We don't know, and that's a fact that we would like to know, because that could be a helpful factor. Because the way the dad treated the general test for a gift is a totality of circumstances, and that's why we think you have very strong arguments, Jimmy and Lucy, but we can't give you 100%. And so
does it matter? So I don't control what my dad does. So does it matter if he filed a gift tax return? Does that change your answer if he didn't?
No, it doesn't change our answer, because what matters is what your dad intended to do when he made you the debt forgiveness. Did your dad give it to you out of what it was called, the standard is detached and disinterested generosity? So did he give it to you as your dad, or did he give it to you in order to get something in return?
Wait, can I interrupt you on that point,
sure, sorry.
Sir? When you say on something in return, my concern here is we're calling this a gift. And unless I missed the facts, Jimmy quote, gave his dad a car worth $175,000 shortly before the dad forgave the loan. Is it clear what we have here is a gift, or is what we have here a bargain purchase? And so that the cash, so that the payment should be characterized otherwise. I recognize the tax answer may be the same, but the taxability potentially, depending on basis and depreciation and all that stuff. But what are you going to do if you're going to go contest this notice of deficiency? Are you going to put all your eggs in the gift basket?
No, that's our main position right now is that we will try to make sure the IRS understand that for us, it's a gift position. If the case has to go towards a court, we will have an alternative position. So you're right that there is a possibility that it was an exchange, right? That the Tesla was given in exchange for the debt forgiveness. In which case, we're talking about a potential income of $50,000, which would be the difference.
When you say it was an exchange, what does that mean? I just gave him a Tesla and he just decided that I didn't owe him the money on the debt. What do you mean?
Yeah, and what do you mean by 50,000 of income? That caught my ear, my ears.
Yeah, I know, and I agree with you. I'm building a hypothetical situation in an interpretation that the IRS would take that we would disagree with. And the IRS position would be, well, you gave a Tesla and then your dad forgave the debt. And therefore, the debt forgiveness was a payment for the Tesla. The value of the Tesla that you bought was $125,000 and the debt was $175,000. And so the difference between the two of them would be a gain for you because that's in effect the value that you got in exchange for the Tesla, and you would be taxed on it if the IRS were correct. We think the IRS is wrong. First,
let me ask change the facts. Like, you haven't seen the notice of deficiency yet, have you?
Correct.
What happens and how does it change your strategy if the notice of deficiency doesn't say that this is a canceled debt, but instead says that, Jimmy, you sold a Tesla, which you bought for $125,000 and you sold it for $175,000? Is that going to change the way you handle things?
Partially. So the first position is going to remain the same, as in we have a gift, because we don't have any facts that points toward a connection between the two of them. If the dad really wanted to exchange a debt forgiveness for a Tesla, why did he wait 2.5 months? The fact that they are in a father-son relationship, is pretty clear that, it's a very natural thing between family members to exchange gifts. The fact that, Jimmy made a gift to his dad made a gift to him a few months later, it's no different than, let's say, Jimmy had a birthday in the summer and his dad made him a gift for Christmas. I mean, we wouldn't qualify that as an exchange. In order to make sure that, our position is correct, what we'll need to know from the dad is, first, we'll need to get the letter. I think the letter forgiving the debt is very important for us, just to make sure that there is actually no quid pro quo between the debt and the Tesla. Any communication around the Tesla gift would be great. And there are other elements that we would need because there's other potentials. We would need like all the tax returns of Jimmy and Lucy from 2016 to 2019. That would be just to make sure that it's not related to Jimmy's employment. The debt forgiveness was not part of any employment compensation. And one of the important things that we would need is that whether or not the dad is willing to either write an affidavit, be interviewed by the IRS, or even, be willing to testify in court that he intended to make a gift. Now, there is an alternative position. Sorry, yeah.
I filed a joint return with Jimmy. Does this gift have to be to me too? I mean, what's my exposure here?
So our position right now is that your interests are aligned in terms of the audit. However, if the audit does not go our way, Mike will explain to you how you could get relief for Jimmy.
Okay. Yeah. Hi, Lucy. So I'm going to explain the procedure of how we want to take advantage of this gift argument, but let me talk about the potential liability to you. So you guys did file a joint return, so there is joint and several liability. Now, you had mentioned the possibility of maybe an innocent spouse relief claim. So as Louis laid out, we believe the best advice for you now is the same advice for Jimmy, is to fight this this argument with the IRS as a gift. And this is because if this argument is successful, there will be nothing for you to need to be relieved of after the fact. And after the resolution of either the tax court case, or if we are able to resolve this just with the IRS, you will still have at least up to 2 years to be able to file an innocent spouse relief claim. So you will not give up
What
your
does
claim.
innocent spouse mean? She's as much liable as I am.
Yeah, I'm not.
R2.
So this was just, we know that Lucy was interested in this. Innocent spouse is just a way, sometimes when one spouse thinks that they shouldn't be on the hook for something because they didn't even know that the other spouse, you know, did this transaction at all.
She knew everything going on. This does not seem like the kind
not
of
true.
conversation that you should be having with my wife who filed the joint return. We're not divorced yet.
Yes.
And we agree with
and-
you that I think at this point, we probably should not get into the specifics of that issue, just because, as you mentioned, as is clear here, there is a potential conflict of interest. And you know, we have there is that relief. There is certain elements that you will have to show in order to qualify for the relief, but we can't really go into the details because it's a conflict. And if there's a conflict, we cannot represent you both on the
But
matter.
you know, if we're going to fight this in an audit and things come out, I can't close my ears. I'm going to know that stuff. I mean, is that going to come back to bite me if I then ask for innocent spouse relief because all these facts come out on an audit?
We're just trying to explain that innocent spouse relief is a different claim that could be made at this time, but also can be made after this gift argument. We do believe this gift argument is strong. We believe that the best way to go about this is administratively. We are unsure if you've picked up the 90-day letter yet, unsure if you guys have received it. Either way, we would advise you guys to pick up the phone and call the IRS agent and still try to resolve this with the IRS, making the gift argument.
Us?
Wait. Can I interrupt you? I
Sure.
apologize.
I'm sorry, your accountant, Jimmy.
Yeah, no, I just want to make sure. You said to call the agent after you receive the 90-day letter. What do you do when you receive the 90-day letter? Is there any reason to talk to the agent at that point? Can the agent withdraw it?
No, but we can still request an appeals conference. Now that the IRS doesn't have to give us one after the 90-day letter is sent, but we can request one. And one way.
What do we have to do when we get the 90-day letter?
So if we want to, now again, this depends on what has happened previously. We have not represented Jimmy and Lucy up to this point, so we're unsure if you guys went through an appeals conference. If you guys did not, we would just be filing a petition for the tax court. That's what the 90-day letter sets out. But again, we would recommend trying.
If they hadn't gone to appeals yet, and you
Yes.
get the 90-day letter, would you still file the petition automatically, or would you try to do something else?
If you guys just receive it now, we may try to resolve it. Again, we have 90 days to file this petition. We may try to resolve it before initially filing the petition, but again, we would be able to file the petition and still request an appeals in that time.
Well,
I'm watching the
file a
clock.
petition? Can I file a petition separately?
For innocent, I'm sorry, for tax court?
Yeah.
Yes.
So why shouldn't I just file a petition? Let you guys figure it out on appeals.
Again, we're in a little bit of a territory here where there is a clear conflict of interest if you are going to pursue this route. So we would
And
try.
I'm not paying for you to go and do something on your own right now.
Well,
I'm going to interrupt here as the partner. We still have a couple more issues. We've used up half the time already. Let's move on to the hobby loss, please.
Thank you very much, Louis.
So
Thank you
much
very
fun,
much.
though.
And so for the band, as of right now, we have some concerns as to whether the band can qualify as a business or as a hobby. And why it's important is because if the band qualifies as a hobby, is characterized as a hobby right now, it will not be able to take any deduction until 2026. And then after 2026, the amount of deductions will be limited. We have a plan, however, that we think is pretty sustainable that will allow you to take deductions right now and going forward. Under the IRC section 183, a taxpayer is allowed a presumption of for-profit activity, which would qualify it for the business deductions, if the taxpayer generates a profit in 3 out of 5 consecutive years, you can elect right now to be treated as being a for-profit activity with the IRS. And so the IRS will not look at whether or not you made your profit until the 5th year of activity. So if you file right now, you can spend 4 years trying to generate a profit. And then in the 5th year, the IRS will go back and say, did you or did you not make a profit? If you did not make a profit, you do not benefit from the presumption. However, that doesn't end the analysis. The IRS, the Treasury has issued in its regulation a 9-factor test that really tries to target as to whether you're serious about making a profit or you're just engaged in an activity for fun as a hobby, right? And it's how do you carry yourself professionally, like the manner of the business is conducted, your expertise, the expertise of your advisors, how much time and effort do you devote to it, any your financial position in general and the success of the activity in itself, and any amount of personal pleasure. So at this point right now, you have a lot of personal pleasure in the band and you don't have a very strong history of profit, but there are steps, practices that you can adopt right now that will allow you to qualify even if you don't make a profit by the end of the period. The steps that we recommend you strongly to adopt right now would be adopt a separate bank account for the business and make all the payments from that bank account, get all the receipts from that bank account. Keep accurate books and records. If you can afford it, hire an accountant to do that. Create advertisement for your bank, create social media accounts, be active, either in print, online, whatever you can do to advertise. Adopt a written business plan that will show a road to profit, but also, over the course of the next 4 to 5 years, you got to make sure to modify that business plan. You got to identify the practices that you've taken that are not profitable, get rid of them, adopt new ones. Lucy, I understand you are the manager of the band, and if you remain the manager of the band, you'll need to make sure to show the IRS that you are professionally qualified. That is, do you have any qualification, any degree, or any type of experience that could justify? And of course, you'll need to dedicate a serious portion of your time and efforts. That means go on tour, play gigs regularly. I understand you're recording an album. That's a good thing. So with all these elements, we're pretty confident that when the IRS looks back and if you don't benefit from the presumption, you'll still satisfy the test.
So I'm kind of nervous now, though. It's today, and my accountant told me I got to do a tax return for this year, and I've got these expenses. How do I treat them today? I have no idea. I mean, I hope we'll hit, but I have no idea. This is a very fickle business. And so what should I do today?
Did you say
sorry.
I was the manager of this band? I'm not the man, and especially if we go through the divorce, I'm going to wipe my hands of this.
Well, in that case, you'll need to hire another professional manager. It's whoever is the manager. As of right now, Lucy, I understand that you're the manager. We don't know how amicable the divorce will be and whether you'll stay with the band.
So I have to hire a professional manager? That's something that the IRS
Okay.
requires?
It's not a requirement. So there's not a single factor that will make or break it. However, having professional people do the work is a factor that the IRS will take in consideration. So if all of you are not professionals, not qualified, that is something the IRS will consider negatively.
So I know I've talked to my accountant before on similar types of issues, and my accountant has said that if I get a opinion that's signed by a law firm, that's something that I can rely on my tax return. Are you willing to write me an opinion today that all of my expenses from the band will be deductible?
Well, the issue then is that, are we making that effort in good faith, or are we just staging it? I'm not too comfortable writing it right now with the target of avoiding any liability.
So then what should I do?
Well, I think you should adopt those practices, make the election, and at that point, we're very confident that you will qualify as a business, even if you don't meet the presumption. The safest route really is to generate that profit, but without the profit, if you keep those steps, we're very confident that you'll qualify as a business.
I
And
mean,
then
it's very
deduct the
nice that you're
expenses.
telling me on the phone. I want it in writing. Dick, what can you do?
I was just listening to this for a minute and saying, we will have to get back to you on that one, Jimmy. I don't think we have an answer yet. And I know if I'm looking at my clock right, we've only got about 5 more minutes to go and 2 more topics. So we better move quickly. And I think you've given us some guidance. Go ahead. We need to talk about depreciation in a divorce in 5 minutes.
Thank you.
Do you want to
Mike,
skip the depreciation issue, Dick?
Yeah, well, yeah, let's do first the divorce. I think we really want to hear about the divorce. Michael, you have no volume.
Mike,
You're
your mic is off.
Can you guys hear me now?
Yeah. Yes.
All right, thank you. So yeah, the divorce settlement. The divorce settlement is the most straightforward. We think of the issues that we researched today. The law is pretty clear. When you guys separate and transfer property between each other, there's going to be no immediate tax consequences, and whoever gets the property will end up getting carryover basis. There will be tax consequences if you guys were to sell the homes down the road. So there is some tax planning that could go that could be beneficial here for you two, depending on how you two felt and which homes you wanted to keep. For example, there's a gain exclusion for homeowners who sell their principal residence who've owned and used it for 2 years. Right now, you guys qualify, or Jimmy at least qualifies for $250,000 gain exclusion there. If Lucy were to use the home for another 3 to 6 more months, then you guys could qualify for a joint $500,000 gain exclusion on sale of the home. And this is on that San Diego home. So there is some potential for some gain exclusion there.
Does it matter if we do it before we're divorced?
No.
Okay.
I mean, as long as Lucy, if you're talking about to meet the gain exclusion.
Yeah.
Yeah,
I mean, what if we decide today to just go our separate ways, but we don't have anything in writing?
Well, you do need we would need a divorce agreement. This is all pursuant to the law states it's out pursuant to a divorce agreement. So you do need the agreement.
And does it matter if, during the months we were in Provo and in the, the ski resort, we rented out the house by Airbnb? Does that matter?
No, that's not going to affect the use that the use for the requirement. Quickly, if I could, I would like to talk about the depreciation. Is that okay?
Just trying to, on the divorce, as part of the divorce, I know we talked briefly about the tax returns and the innocent spouse issue.
Yes.
How does that tie in with a divorce? Do you have that part of the divorce arrangement? Any thoughts on that, or is that something we'll need to look at later with separate counsel?
It depends on how Jimmy and Lucy feel. If Jimmy and Lucy feel they can come to an agreement, that is something the liability for the audit. That is something that could be in the divorce agreement. Again, it depends kind of on Jimmy and Lucy how comfortable they feel with that. If we do go down that innocent spouse road and they're looking for different things, then we're going to need different counsel. Okay,
so then if you're ready, then go ahead and cover the depreciation.
So for Stark Enterprises, you guys made some renovations in 2018. And at that time you had to use a 39-year depreciation schedule. The law has been changed now due to the coronavirus. Congress passed the CARES Act this spring. So now the cost that you guys spent in 2018 that Stark Enterprises spent, they're eligible for a deduction basically for the full amount, this 100% bonus depreciation that was in the TCJA. So Stark Enterprises could be eligible for a refund anywhere from $200,000 to about $350,000, depending on their ability and when they absorb that deduction. So this change is retroactive, and meaning that taxpayers like Stark Enterprises who already filed their 2018 and 2019 returns, they can still take advantage of it now. The IRS has actually given, there's at least 2 ways for Stark Enterprises to take advantage of this. They can go back and amend their 2018 and 2019 returns and apply that 100% depreciation in their 2018, the year it was placed in service, or they can just reflect this the rest of the deduction that's left, which should be about $950,000, entirely on their 2020 tax return.
But let's talk of the mechanics of that. If
Sure.
Stark Enterprises goes back and files their amended return, they not only have to amend their federal return, they have to amend the returns in the 27 states in which they file.
Yes.
So is that a practical way to go? And are we leaving money on the table if we go forward and do it only in 2020? I mean, how do we advise the client here?
So that's what we're balancing here. So this is where we would need to see the corporate returns for Stark Enterprises from 2013 to 2019. That would allow us to be able to know how much money we would be leaving on the table versus the, as our partner pointed out, there's a little bit more involved. If you just do it for your 2020 going forward, you're not worrying about amending all these returns and opening up yourselves to a longer period of assessment by the IRS. However, if you do apply it now, the refund amount is going to be closer to that $200,000 number. Whereas if we are able to actually go back and look at 2013, 2014, and Stark Enterprises has the ability to absorb the deduction, then we'd actually be looking at a closer to $350,000 refund due to the change in tax rates in 2017.
Okay, so what you're going to need to do is run numbers, is what I'm hearing you
We need
say.
a tax modeling exercise that would incorporate Stark Enterprises corporate returns from 2013 to 2019, and then along with these other changes in the CARES Act. There's other taxpayer-friendly things, an interest limitation that was raised, refundability for AMT credits. All of these things need to be thought of together. And I think we're just about out of time. So I just wanted to thank Jimmy and Lucy and partners for being here today, and thanks for listening.
Thank you very much.
Thank you.
Thank you.
Thank you.